HOC, Housing Opportunities Commission of Montgomery County for our June 2nd, 2025 committee meeting. Present with me to my immediate right, Commissioner Audit, and also joining us by Zoom is Commissioner Jeffrey Merkowitz. We constitute the Committee for Budget, Finance, and Audit. I'd like to welcome the staff to the event, and we will proceed with the agenda as has been outlined. The first item before us is, in fact, the approval of the minutes of our meeting of May the 8th, 2025. Can I get a motion to approve the minutes?
So moved.
Second.
Probably moved and seconded. All in favor signify by saying aye.
Aye.
Aye. Opposed, nay. So ordered. The next item to come before us, which is the third quarter unaudited financial statements. Now I'll turn to our president, Kelsey Andrews.
Yes, good morning, commissioners, members of the public, and the HOC team. You will hear before you a number of items that come before this committee and to the board on a quarterly basis related to our financial position. We have presentations from our from our finance team, but I want to highlight a few key facts for you that, of course, our CFO will also provide some commentary on. Our overall financial position is healthy and stable. We do continue to experience property variances, and the timing of our commitment and development fees are the biggest drivers of our current financial performance at this time. There was a slight decline in our net position. However, you will note in the materials provided that we did have a significant increase in our operating revenues and a wonderful spotlight in regards to rent and tenant receivables beginning to look more favorable. As it pertains to the properties, I just want to highlight and remind us that we are in a very aggressive state of lease enforcement, and we are on track with what we projected in terms of getting stabilized across the portfolio. As previously presented, our scattered sites, we expected stabilization by December. We are on track to stabilize that portfolio by December. Cider Mill, we stated that we would have stabilization by September, and we are on track. RAD 6, we expected stabilization by July. We are also on track. And so while you do see that these portfolios are currently reflecting negative income and variances, we are on track as it pertains to lease enforcement and expect full stabilization by Q1 FY26. And with that, I'd like to turn it over to our CFO, Tim Getzinger, to provide some additional highlights and his team to bring us through today's matters.
Thank you, President Andrews, commissioners, and the viewing public. For the record, Tim Getzinger, Senior VP of Finance and CFO. Today, the finance team will be presenting on 4 items, including unaudited financials, budgets to actuals, tenant write-offs, calendar year audits, and the compliance team will be presenting an update of the single audit corrective action plan. The following is a high-level summary of the agency's FY25 Q3 financial position. Staff will present details in the aforementioned presentations. HOC's financial health remains stable. Total assets increased by $82.4 million to $2.27 billion, the highest in agency history, primarily driven by development activities. Net position decreased by $4.5 million from the start of the fiscal year, mainly driven by operating items, particularly the timing of commitment and development fees and property performance. However, this improved by $3 million quarter over quarter. After adjusting the net loss for the unrealized gains on investments, HOC ended the third quarter with an adjusted net loss of $7.2 million, compared to an adjusted net loss of $3.4 million for the same period last fiscal year. Current and quick ratios are slightly down from the beginning of the fiscal year, but remain healthy at 3.09 and 2.54 respectively. Both ratios are up quarter over quarter for the first time in a year, and those two ratios are the current and quick respectively. HAP utilization has continued to decline and sits at 94.5% due to a slight increase in awards, but primarily due to end of participations from failure to recertify, followed by the unfortunate increase in deaths. Staff have modified its leasing plan, increasing its monthly applicant screening by 67% from 300 to 500 applicants per month, and expect that these efforts will yield positive results. Tenant arrearages continue to be an issue with an aggregate balance of $15.2 million. I am pleased to report that the agency witnessed its first true quarterly reduction in 3 years as arrearages fell by $881,000. And by true, I mean, if you back out the COVID-related rental assistance that we received, it would be the first time in 3 years in which we had a reduction. The quarterly increase had been 1.1 for the past 6 quarters, so this represents a $2 million swing in the right direction. Reserves, including the general fund operating and property reserves, are stable. However, end of the year performance may impact reserves. A review of the 9 revolving development funds also demonstrates stability and are projected to improve with upcoming commitment and development fees. As indicated in the budget to actuals, although there is slippage in commitment and development fees, this is normal, and the timing and amount of fees are subject to change in the financial market and project cost, which creates both timing and dollar variances during the year. Additionally, the negative general fund budget variance has decreased from last quarter $2.5 million to $996,000. Post-COVID renormalization of operations is underway, and as the Commission is aware, this is a long process as the court system continues to be a hurdle in repossessing and repositioning our inventory. Of the $7.78 million in FY25 Q3 property budget variance, the 12 properties with the highest variances represent $6.5 million or 84% of the total variance. And when mapped with the tenant receivable balances, which is a key indicator of whether a tenant in a property is paying, the results continue to indicate that scattered sites, Cider Mill, Battery and Bradley, and the 2 Glenmonts are driving major variances, which is why the agency continues to focus its efforts on these properties. And with that, I'd be happy to answer any questions, or we could advance to the first packet item, which is our unaudited financials for the 3rd quarter.
Are there any questions from the committee?
Not from me. Thank you.
You can go ahead and proceed.
Thank you. Presenting the first agenda item is Will Pass, our Assistant Controller. Will?
Good morning, Commissioners. My name is Will Pass. I'm the Assistant Controller here at Housing Opportunity Commission. Nice to meet you all. I'll be presenting the financial highlights for the unaudited financial statements. As of Q1, March 31st, the Commission's increased by $82.4 million to $2.3 billion for fiscal year end 2024, due primarily to the acquisition of Battery Park in fiscal 25. After adjusting the net loss for unrealized gains on investment and gain on sale of assets, HOC ended the 3rd quarter of fiscal 25 with an adjusted net loss of $7.2 million, compared to an adjusted net loss of $3.4 million for the same period last fiscal year. The Commission's current ratio of current assets to current liabilities decreased from 3.46 in June of 2024 to 3.09 in March of 2025. Similarly, the quick ratio reflecting current assets that can be converted to cash within 90 days also decreased by 2.98 in June of 2024 to 2.54 in March of 2025. The slight decrease is mainly attributed to a decrease in the restricted cash equivalents, partially offset by an increase in accounts receivables, coupled with an increase in short-term debt. The increase of $82.4 million or 3.76% in Commission's total assets, including the deferred outflows of resources from $2.2 billion in fiscal 24 to $2.3 billion in March of 2025, is largely due to an increase in net capital assets, mortgage loan receivables, account receivable, and other assets, partially offset by a decrease in unrestricted and restricted cash equivalents, and investments. The increase in net capital assets is attributed primarily to the acquisition of Battery Park, the waterproofing and plaza repair project at the Metropolitan, the demolition costs at Elizabeth House, pre-development costs at Garnkirk, redevelopment of Emery Grove, construction costs at the HOC headquarters, and capital improvements and turnover expenses at Westwood Towers, Glenmont Crossing, and Glenmont Westerly. This increase in fixed assets is partially offset by the normal depreciation of assets and the sale of 10 scatter site units at McKendree, MPDU, and the normal depreciation of assets. The increase in mortgage and construction loans receivable is mainly attributed to additional draws from the PNC real estate line of credit for Westside Shady Grove Building B, HOC at Willow Manor LLC, Wheaton Gateway Development, advances from the FHA Risk Sharing Reserve for Elizabeth House 3, and Housing Production Fund draws for Hillendale Gateway LLC. This increase is partially offset by scheduled amortization of federal financing loans of several discrete component properties. The increase in accounts receivable and other assets is largely due to accrued development fees for HOC at Shady Grove LLC, HOC at Georgian Court LLC, and HOC at Stewartstown Homes LLC. Rent subsidies receivable at VPC 1 and 2, the Oaks at Four Corners, Alexander House Development Corp., Magruder's Discovery, and Paddington Square, as well as insurance claims, prepaid insurance and taxes. The decrease in restricted cash, cash equivalents, and short-term investments is largely attributed to scheduled bond redemptions, additional draws for HOC headquarters, bond proceeds, approved drawdown of bond fund for fiscal 25 operating budget, and the single-family bond fund mortgage-backed securities purchases. The funding of the general fund operating reserve for the general fund excess revenue also contributed to the decrease in restricted cash and cash equivalents. Any questions so far? Okay. The decrease in unrestricted cash is largely due to the following: annual payment of county self-insurance for liability, property and workers' compensation, solid waste taxes, and Alliant Commercial General Liability and Excess Liability Insurance, and renewal of Yardi license and maintenance for SaaS private cloud system. Fiscal 25, a retroactive wage adjustment, which was processed in September 2024, the employee retirement system's contribution to unfunded actuarial liability. Repayment of PNC construction loan of Elizabeth House 3, the FHA risk share reserve, timing of advances to several component units, OHR advances for battery park acquisition, battery costing refinancing, the Metropolitan redevelopment expenses, and the Lindley preferred equity contributions. Partially offset by an increase in several properties, unrestricted cash mainly accounted for the decrease in the Opportunity Housing Fund. The decrease was partially offset by cash inflows consisting of commitment fees and development fees from the Hillendale transactions, a state grant for the Metropolitan Green Roof Project, drawdown for the multifamily and single-family reserve funds, and reimbursement from Westwood Tower Apartments and HOC at Garnkirk Farms LLC for interest and pre-development expenses, respectively. The multifamily bond fund issued a $50 million limited obligation bond housing production fund and $42.8 million multifamily housing development bond, Series A for Battery Park. The multifamily bond fund redeemed and retired bonds for $14.5 million under the multifamily housing development bonds, $1.8 million under the standalone 1998 issue, and $0.7 million under the multiple purpose bonds. The single family bond fund redeemed and retired bonds under the 1979 indenture for $8.1 million, the 2019 indenture for $2 million, and the 2009 indenture for $0.3 million. The amount of U.S. Department of Housing and Urban Development Housing Choice Voucher Program housing assistance revenue received by the commission increased by 9.07% from $103.6 million in fiscal 24 to $113 million in fiscal 25. Any questions so far? No.
Let me go back for a moment.
Sure.
Just a question on I noticed that in terms of the impact on the restricted cash has been due somewhat to the drawdown for the headquarters building.
Yes, sir.
What are we looking for going forward in terms of, I mean, that building is almost nearing completion now. So I've been noticing in each of our reports, we've been seeing some impact that's becoming associated with the headquarters building. Is there anything that you can say about that in terms of what we should look forward to going forward in terms of our financial position on respect to related to restricted cash?
Well, in terms of restricted cash, that will be utilized through some of the operations. But as we draw down from the bonds, it moves from one portion of the financials to the other. It goes into the cash, and that does increase where the cash is. As you draw that down and as you draw down construction costs, you do see a reduction in the restricted cash. Yes, that is accurate.
Okay. So, yeah. The other thing was the fact that we are still experiencing some problems in terms of the process with the courts on delaying processing our eviction proceedings. I don't know that it's appropriate that we should be doing it, or whether or not the other industry players, in addition to ourselves, who are facing the same problem, could be having some kind of conversation with the court system about some way that they could expedite the processing of these kinds of requests. I mean, it's happening all across the country. We're seeing it in our neighbor communities, but it seems like something needs to be done about that, because just for the court to see the impact of their schedule delays on impacting organizations that are involved as we are in housing, I don't understand why something can't be done there.
And I think, you know, the way that it was worded might give the impression that we're being treated differently than others, but we're not. This is the typical time frame for lease enforcement. It takes about 9 months to get through the process. Of course, people come in, they might have representation, they can request a continuance, they can come back with additional funding sometimes to help support, but as a whole, we're just moving through the process as best as we can. And definitely in terms of the backlog that they experienced post-COVID, in terms of lease enforcement, I'm certain the court is working their way through that, you know, of course, receive your suggestion if there are opportunities for us to work with partners around how to move quicker. That would be ideal, but it does take about 9 months to work through cases.
Yeah, I mean, I don't feel we're being treated differently.
Right.
I just think that all of us who are being treated the same, which is not very good, should be doing something about trying to address that. That's my only point I'm making.
Understood.
I think that is a very good observation. What I can say is, from my time working at the county, the legislative branch and the executive branch were always very willing to step in and work with us. The judicial branch and the sheriffs, not as much. They are very regimented in what they do, and they very rarely do change what they are doing. But it has been a difficult process, and it's something that it would be great if we could somehow have streamlined. And
yeah, just pivoting off the chairman's comment, I was going to bring it up later, but it's a good time to bring it up, as I was also struck in the materials by comments that we had tried to provide financial assistance to certain residents, and the end result was those residents didn't return to payment and delayed the process of going to lease enforcement. And there was a, shoot, I'm forgetting the other example. I said, oh, just whenever we start the loan collection process or the enforcement process, any payments we were getting stop also. And I guess I'm just commenting that it's kind of the unintended or the negative impacts of doing the right thing.
Right. And we don't want to give a broad brush, but because there definitely are different circumstances for every family, but across the board, our experience has been one where, despite the additional relief that has been provided to certain families, they had a difficult time getting back on track.
Yep.
Yes.
okay, if we could move to, I believe it is page 11, the combined statements of revenue and expenses. Perfect, thank you. Okay, the commission had a total net loss of 4.5 million during the 9-month period ending March 31st, 2025, compared with a net loss of 5 million for the same period in FY24, excluding the unrealized gain on investments of 2 million and gain on sales of assets, again, for that 700,000 from the sale of the NPDUs. The HOC ended with an adjusted net loss of 7.2 million in FY25 as compared with a net loss of 3.4 million in FY24. Again, this was mainly due to an increase of administrative expense and fringe benefits driven by the general fund wage increase, housing assistance payments under the HCV program due to higher payment standards, interest expense within the multifamily fund, and maintenance expense at the property level. The increase in expenses is partially offset by an increase in revenue, primarily HAP revenue, multi-fund investment income, development fees, loan management fees, commitment fees, dwelling rental income, and interest on mortgage and loan receivable. The gap between HAP revenue and HAP expense, which is typical due to the timing of the release of additional funds, we have requested from HUD, from their HUD held reserve. Our request from the HUD held reserve funding is currently being reviewed by HUD, and we are expecting to receive the funds as soon as they complete their review. The total operating revenues increased by 19.2 million from 229.2 million in FY24 to 248.4 million in FY25, largely driven by an increase in HAP revenue, management fees, rent revenue, investment, and interest income. Excluding the HAP revenue and unrealized gains on investments, the commission ended with an adjusted operating revenue of 133.4 million in FY25 and 127.2 in FY24, for an increase of 6.2 million. The operating expenses also increased from 239.2 million in FY24 to 261.2 million in FY25, up by 22 million, due primarily to an increase in the HAP expense, administration, fringe benefits, maintenance, and interest expense. If we exclude the HAP expense, the increase in adjusted operating expenses are 11.6 million from 133.6 to 145.2 million. The non-operating net revenues after backing out the gain of sales for those 10 scattered site units amount to 7.6 million in FY25, up by 2.5 million from 5.1 million in FY24. An increase of investment interest and investment income, interest income on mortgage and construction loans receivable and other grants partially offset by an increase in interest expense accounted for the non-operating revenues favorable variance. More detailed information is provided in the notes to the financial statements later in the packet, and this includes the financial statements presentations, and I would be happy to answer any questions. There are additional charts. This is the consolidated revenue and expense. What we then do is we break out the balance sheet by the 5 funds, and then we also do the same for the revenue expense by the 5 funds. But we talk about the consolidated financials.
Tim, Will, thanks, and Chelsea. When as I was going through the materials, getting ready for this meeting, the one comment I wrote in my notes was administrative expenses are running hot, and I'm just understand how they'll fluctuate with the HAP contracts and all that, but the non-HAP stuff is running hot. Is it cyclical because of the different expenses that came in this quarter, or is it something we should be concerned about?
It is with not only within budget, but if we were to take a look at what we were projecting, it's actually a little bit lower. It does generally increase, yes, but we do monitor that on both a quarterly basis and then comparing it to other Q3s over different fiscal years. It is higher, but that's partially because of inflation. It's also partially due to the union wage negotiations and agreements that we made in the first quarter. There would have been a higher offset during that quarter because that's when that actually hit. It is normalizing, but it is fair to say that the administrative cost is increasing, but that is within the norm of any practice.
The second question I came in with is a much more minor point. It has to do with the sale of the 10 units and I'm the new guy here. So were those the 10 units we sold to a Habitat
That's correct.
for the homeownership program?
Yes.
Real quickly, so we netted $740,000 from the transaction, or that was the sales price?
I'm not sure if it was 770 or 740. It was,
740,
okay, yes. That would not be the net. That would be the total.
And
receipts.
so we sold them to Habitat for 74,000 each. What was it?
90,000 each.
Yeah.
And netted 740.
That
Anyways.
is correct. That is the net. This is Eugenia Pasqua. Yes, we netted 740,000 from that transaction.
Got it. Thanks.
Any other questions? Okay. Is that the end of your presentation on
That
this?
is the end of the presentation, and there's no votes that need to be taken.
Yeah, this is a report to the committee. This does not require us to forward anything to the full commission.
Correct.
Okay, the next item on the agenda is the
Thank you.
third quarter budget to actual statements. President Andrews.
Yes, thank you, Commissioner Chair Priest. This next item will be presented by our budget officer. Again, the initial remarks made by both myself and the CFO set the stage as it pertains to the variances typically are tied to property performance and the timing of development and commitment fees. I will turn it over to Terry Fowler to provide more details.
Thank you, President Andrews. Good morning, commissioners, viewing public and staff. For the record, I am Terry Fowler, the budget officer. And as President Andrews mentioned, I will be providing details to the third quarter budget to actual statements for fiscal 25. If we could turn to page 13 of the packet, please. Thank you. The agency ended the quarter with a negative variance of approximately $7.2 million based on a net cash flow shortfall of approximately $6.7 million compared to the anticipated third quarter positive cash flow of approximately $462,000. As has been mentioned, the primary causes were lower unrestricted cash flow from our development corporation and opportunity housing properties, coupled with lower income in the general fund, partially offset by savings in various expense categories in that fund. Continuing at the top of the page, the general fund consists of the basic overhead costs for the agency. This fund ended the quarter with a deficit of approximately $7.4 million, which resulted in a negative variance of just under $1 million when compared to the projected deficit of $6.7 million. This represents an improvement from the cumulative negative variance of $2.5 million reported in the previous quarter. As of March 31st, income in the general fund was approximately $4.9 million lower than budget, and expenses were approximately $3.9 million lower than budget. The negative income variance was primarily the result in the delay of planned commitment and development fees. A large portion of these has shifted to fiscal 26 and is included in the budget that will be presented to the Commission on June 4th for adoption. The impact to the general fund of the delay in fees was approximately $4.3 million. And if those fees had been received, we would have had a small negative income variance of about $568,000. The positive expense variance was primarily the result of lapse in salary and benefits coupled with savings in miscellaneous contracts and capital projects, which resulted in lower transfers from the operating budget to cover the cost of the projects. Moving to the bond funds on the same page, the multifamily and single, same page at the top, thank you. The multifamily and single-family bond funds experienced positive expense variances of approximately $327,000 and $247,000 respectively as a result of salary and benefit lapse coupled with savings in publications, registration fees, and professional services. If we can move to the next page of the packet and the top section, please. As mentioned previously, the main impacts to our properties have been a combination of increased vacancy loss, largely due to the increased lease enforcement. As a result of that, we have had an increase in maintenance expenses as units have been taken back and set for pre-leasing. We also saw continual increase in bad debt in the third quarter as several properties were aligning their allowance with their receivable balance of tenants that were more than 90 days overdue. The first set on this chart on the page, it's broken into two pieces, and the top is the unrestricted properties and the bottom is the restricted. The top group ended the quarter with a negative cash flow of approximately $366,000 or 3.95 less than projected. The bottom section, which is properties that we do not depend on cash flow, this group, the shortfall of the group was $352,000 more than the budgeted shortfall expected at the end of March. The largest variance there was the RAD 6 for the various reasons I mentioned before, with the exception of occupancy, which has begun to stabilize at the properties. Moving on to page 15 of the packet. Again, the top section is the unrestricted property, and this group ended the quarter with cash flow of just under $2 million or 1.78 million less than projected. The bottom section of the page is the restricted properties, and the shortfall for this group was $1.69 million more than budgeted. Do you have any questions on what I've presented thus far?
Any questions? No. No.
Okay, then we can move to page 16 of the packet. This presents our public fund, our restricted housing choice voucher program. This program ended the quarter with a shortfall of approximately $382,000, which was comprised of housing assistance payments that exceeded new revenue as encountered by the administrative surplus of $516,000. As our CFO mentioned before, the request for the funds that are available to us but held at HUD is under review, and we sometimes see a timing variance in what our expenditures are and what our funding at the agency is. The administrative surplus was the result of higher fee income and lower administrative expenses, mainly due to staff turnover. The higher administration fee income was primarily the result of the increased proration rate of 97.38% received for the first 6 months of our fiscal year. The budget was 91%, and in January, HUD returned to a 91% proration on admin fees. We also had unanticipated income from two new programs this year for stability and homeless vouchers. That concludes the operating section. On the last page of the packet, we are presenting a point-in-time picture of our capital. You will notice that there are several properties with nominal unplanned expenditures, but we've had increase in expenditures at a few properties due to emergency elevator and boiler replacements, as well as work related to the HUD Inspire inspections. The majority of the properties do have sufficient property reserves to cover the overages, Where this may not be the case, staff is reviewing the obligations from our Opportunity Housing Property Reserve, or OHPR, to ensure sufficient funds are available to cover the balance of the overages. That concludes the presentation, and I would be happy to answer any questions you may have at this time.
I noticed that on the operating for Opportunity Housing, where the biggest variance there was really, it seems like the Barclay Development Corporation.
I didn't hear.
The Barclay Development Corporation variance was $139,000, or what was the budgeted amount versus actual? You're pretty clear about describing what things happened that caused those. Can you know specifically on that one, what the
Sure.
situation was?
They had savings actually in their bad debt and maintenance expenses, as well as utilities, and slightly higher gross rent potential. Gross rent potential means that if the property were 100% occupied at the rents at the property, that would be your income. So the rents at the property were slightly higher than budget, and that against the savings in utility and bad debt and maintenance expense resulted in the positive variance.
Okay. Yeah. Any other questions?
No questions from me. Thank you.
Okay, thank you.
Thank you.
Thank you.
The next item is one of our favorite subjects always is budget, finance, and audit is uncollectible tenant accounts receivable.
Commissioners, we present this item on a quarterly basis. It reflects our lease enforcement activity and ultimately stabilizes our finances to properly reflect what we anticipate receiving from our tenants. We are continuing to see high numbers of accounts receivable, but it's in alignment with our expectations as we're moving our way through lease enforcement. I will turn it over to our finance team. I believe this presentation is coming by way of Sewa Abajan, our accounting manager.
Thank you, President Andrews. Good morning, commissioners, staff, member of the public. For the record, my name is Sewavi Prince Abujan, accounting manager with HOC Finance Division. We are seeking your support for the write-off of uncollectible tenants account receivables for the third quarter of fiscal year 2025. HOC's current policy is to provide for an allowance for any tenant account receivable balance in excess of 90 days. Additionally, HOC periodically proposes the write-off of uncollected former resident balances. Next page. The proposed write-off of former tenant account receivable balance for the third quarter of fiscal year 2025 is $652,007. As with the last few quarters, lease enforcement was by far the largest driver in write-off, accounting for 86%. Here's our comparative analysis. The FY25 Q3 proposed write-off of $652K is higher than FY24 Q3 write-off of $502K. FY25 Q2 write-off of $304K is much lower than FY24 Q2 write-off of $369K. And finally, FY25 Q1 write-off of $486K was much higher than FY24 Q1 write-off of $132K. When we compare quarter three to quarter two, the FY25 Q3 proposed write-off of $652K is an increase of 115% from FY25 Q2 write-off of $304K. Page 3. We continue our lease enforcement effort with a focus on large delinquent accounts. RAD6 Washington Square is the perfect example where we enforced the lease for 11 delinquent accounts, totaling to $315K in bad debt. The next anticipated write-off for former tenant uncollectible account receivable balances will be for the fourth quarter of FY 25, which will cover April 1st through June 30th, 2025. Any questions? All right.
Yeah, just a comment, it's interesting that as we do more lease enforcement, we see a higher tenant accounts that we have to write off. I mean, I know that that's the way it works. But it's not the way that you like to hear it,
Yeah.
because it just keeps ensuring that we are continuing to write off more and more. At some point in time, we will hopefully be at a point where we have settled our properties in terms of lease up, where we now have some tenants who are in the properties where 100% of them are paying. Now, I know that is an unrealistic objective, okay? Because even in the best management, they always have a 5% factor that you put into your factors like that. But it would be great till we get to a point where we could have a one quarter we didn't have to write off anything. I would give a party. I mean, seriously, that I'd pay for it. But it just, these numbers do get a little staggering. Any questions, members?
No, thank you.
So can I
Okay.
get a motion to recommend to the full commission the third quarter write-off of $652,007?
So moved.
Second.
Probably moved and seconded. All those in favor signify by saying aye.
Aye.
Opposers,
Aye.
nay. So ordered.
Chair Priest, I realize that we also need a motion related to the third quarter budget to actuals to advance those to the full commission as well.
Okay. We will go back on that one to the previous presentation, which was on the budget to actuals. And we need a recommendation from the committee to advance that to the full commission. So can I get a motion to advance the third quarter budget to actual statement?
So moved.
Second.
Probably moved and seconded to approve the third quarter budget to actual report. All in favor signify by saying aye.
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 Aye, opposed, nay, so ordered. The next item on the agenda is, in fact, for the calendar year 2024 audits. I'll turn to our president.
Yes, thank you, Chair Priest and Commissioners. This is an item that comes to the board on an annual basis related to our year properties, our properties that are on the calendar year in terms of their audits. As you'll see in the presentation, we're well underway with completing the majority of the audits. The others will be supplemented, but as it stands, we're experiencing positive feedback in regards to our audits having unqualified opinions. I'm going to turn it over to our CFO, Tim Getzinger, to provide further details.
Thank you, President Andrews, Commission. Again, for the record, Tim Getzinger, Senior VP of Finance and CFO. Please turn to the top of page 2, which is the chart. Thank you. The finance team is responsible for completing 19 low-income housing tax credit partnership and 3 limited liability company audits for calendar year 2024. Please note that Wheaton Gateway LLC is in pre-development phase and does not require any audits for the calendar year 2024. Property audits for 14 calendar year 2024 low-income housing tax credit partnerships and CCL Multifamily LLC, which is known as the Lindley, have been finalized. All audits again are clean, meaning that they have received a standard unqualified audit opinion from their respective independent certified public accounting firms. I would like to recognize the entire property accounting team for this feat, particularly Claudia Wilson and Miriam Caballero, our property accounting managers, as well as Scarlett Sevilla Garcia and Donna Crummer, our property accounting supervisors, for their diligent work in continuing to provide a clean financial operating environment for the agency's property portfolio. The property audits for 7 tax credit partnerships or LLCs are yet to be finalized and are awaiting investor approval. These include 3 separate audits for Hillendale, Willow Manor, Spring Garden, Metro Point, and the Laureate. The final audits for these properties are also expected to receive a standard unqualified audit opinion. Staff requests the committee support its recommendation to the commission to accept the 14 calendar year 2024 tax credit partnerships and CCL multifamily LLC audits. As with last year, the remaining audits would be brought directly to the commission in its July meeting, assuming that there are no issues with these and they were clean. This concludes my presentation, and with that, I would be happy to answer any questions.
All of the tax credit audits are essentially reported to the limited partners. That's correct. Before you bring it back to the commission for us to approve it, right?
Yes, they are currently reviewing them, yes.
Yeah, okay. Can I get a recommendation from the motion from the committee to advance the calendar year 24 audits for our tax credit limited liability companies to the full commission?
So moved.
Second.
Probably moved and seconded. All in favor signify by saying aye.
Aye.
Vote aye. So ordered. Carried unanimously.
Thank you.
The next item that comes before the committee is in fact our fiscal year 24 single audit corrective action.
Thank you. Commissioners, as you're aware, we received our audit for 24 that included some findings related to our performance of our voucher program as well as PBRA. It's not unusual considering the size of our programs that there will be exceptions and an opportunity to strengthen our operations in those areas. We provided, in accordance with HUD requirements, our corrective action plan back in December of 24. And we are providing you with an update in regards to how we're moving along with complying with that corrective action plan. I will turn it over to our Vice President of Compliance, Darcel Cox, to provide more details on how we've come along.
Good afternoon. For the record, I'm Darcel Cox, Vice President of Compliance, and today I will provide to you with updates for the fiscal year 2024, which I will refer to as FY24 throughout the presentation, Single Audit Corrective Action Plan. For FY24, HOC received a qualified audit opinion for the Section 8 project-based cluster, RAD 6, and MOD Rehab, and an unmodified audit opinion for the Housing Choice Voucher Program. The following updates are for the project-based rental assistance program. For eligibility, the audit revealed many discrepancies related to missing applications, documentation to support income and asset calculations, and missing recertification. As a progress update, Produm, which is our one of our third-party management agents, confirmed that staff completed an intro to affordable housing training, which is now part of their onboarding process. The Produm compliance team reviews each move-in file prior to approval and now proactively reviews vacancies to verify that the proper documentation and notes are present. Lastly, the HOC compliance team performed site visits on all affected properties, and the average score is 78%, which is a moderate risk. As it relates to—
1 second,
sorry.
Ms. Cox, if you would look at the screen too, to
Oh,
let them
sorry.
know that they should move it up.
Okay, sorry. You can scroll. I don't know, we don't have pages. Scroll down. You can scroll to the next item. Continue. The next action item. Okay, yes, sorry about that. Scroll down a little bit where it starts at inspections. Scroll up the other way. All right, we're gonna stop it here. So as it relates to the annual inspections, thank you. For the PBRA properties, the audit revealed several discrepancies for both the third-party management agent as well as HOC managed properties. As a progress update, Pradam, our third-party management agent, aligned the annual inspections with the recertifications. HOC had a third-party vendor complete the inspections to bring us current. However, the path forward is to have the HOC maintenance team complete a full inspection twice a year during the preventative maintenance inspection. You can scroll to the next item, action item. Okay. All right. So the audit also revealed two instances where there were track submission discrepancies. As a progress update, the Pradam team conducts monthly reviews and works with the contract administrator to ensure consistency with the compliance requirements. Contract rent, you can scroll down a little bit. And I'll group two sections here. For the contract rent, as well as the utility allowance, they go hand in hand, they're done at the same time. So the audit revealed that there were several exceptions for both the contract rent as well as the utility allowances. And so both corrective actions were implemented following the audit as they are outlined in the document. Scroll down. You can scroll to PBRA vacant units. So the audit revealed here two files where the move-outs were not processed timely. As an update, Pradam confirmed that they ensure all move-outs are reviewed and processed promptly following the audit. You can scroll to the next section. All right, the following updates are related to the Housing Choice Voucher Program. So for eligibility for this audit, the audit revealed only one finding. HRD and compliance continues to work together to identify ongoing training needs. HRD also recently hired a trainer we will work closely together to continue that mission of identifying training needs. The next item, there were two files for HRD that received that revealed two PIC errors. The HRD team received internal training, and the third-party training outlined in this document will occur on June 17th. For the HCV housing quality standards, this audit revealed several discrepancies. Following the corrective action, HRD continued to experience some issues due to a Yardi software malfunction. However, the issue was recently resolved, and we expect to see progress over the next few weeks. Both HRD and the inspections vendor, Gilson, have dedicated staff monitoring abatements to ensure that re-inspections occur within 30 days. And that concludes my presentation, and I'll take any questions at this time. Thank you.
Commissioner.
Ms. Cox, thank you so much. It's, take cleaning up the audit stuff really important. That's a big job. And so a couple of quick questions as I went through it. The first of all is the samples that it's referring to, the 60 files and the number of errors in those files. I assume that the 60s were a random sample that the auditor looked at and found that level of error in them.
That is correct.
Yeah. And the other thing that jumped out at me, are these paper files?
Yes, it's a combination of both. For the Housing Choice Voucher Program, we do have some files that are electronic, but they're paper, but scanned into the system.
Yeah, so the auditors go and take a paper file looking for the annual income certification and not finding it in the file.
Correct. In some cases, yes.
Because immediate thing that leapt out at me is whether we could have a system that say, where the files are uploaded digitally and right away that they're there, right?
Correct.
So I'm sure that's coming.
It
is. And then the other thing that I was curious to me out of this is, so we filed the correction plan with HUD. How are they monitoring it? We have a quarterly report to them on how we're doing, on how we're implementing the different changes? Do they have to sign off on our approvals, our changes?
No, they do not monitor. We are required to submit the corrective action plan and provide you all with a quarterly update on how we're doing. But as far as HUD, then we are not required to provide them with any
And
additional
if our
information.
satisfactory corrections will show up in the next audit.
Correct.
The auditors will come in and do another
Yes.
test. Okay.
Right. And where they do find certain exceptions, depending on the nature of those exceptions, it will automatically mean that we will be re-audited on that program again. So that's how they provide additional oversight.
The auditors will oversample or particularly focus on the particular findings.
Yes. Mhm.
That's all I got.
Yeah. Question I had. I noticed that a number of these findings related to that we have a third-party contractor, Fathom, right?
Correct.
That is supposed to be performing. So I'm trying to understand what oversight does the staff do with our contractor? I mean, it's the auditors are finding these mistakes for work that oversight was done by Fathom. I'm trying to understand, well, what does the staff do to oversight the contractor? I mean, what are we doing to do quality review to make sure that the contractor is doing what they're supposed to be doing?
So, and I mentioned in the presentation, the compliance team does go out and do site visits. And so now we're transitioning our properties to our Yardi environment, and we will be able to provide greater oversight because we'll have access to systems and files, which we did not have for all properties in the past. So we're making some changes to our process internally so that we can provide greater oversight.
Are we still in a contract with Fathom to do the work that they do?
Yes.
When does that contract come up for renewal?
Each property comes before the commission as it pertains to which third-party property manager we have. And so because we have a number of properties that Pradam is the third-party property manager for, it will depend case by case on each of the properties in terms of when those contracts expire. But we're definitely closely monitoring performance, not just as it pertains to compliance, but also occupancy, expenditures, and overall property management of our sites. And we've strengthened our contracts as well to ensure that there is a level of consequence to third-party property managers who fail to meet our compliance and property management requirements. And so that was one of the outcomes of this exercise, was to strengthen those contracts as well. But we have our property management team meets with our third-party property managers often. Also, our asset managers do oversight. Compliance does QCs. There's meetings that happen across all of our various divisions to ensure that the third-party property managers are monitoring. And we're also trying to make sure that they have good internal systems, because they have turnover just like any other division and any other company. And so sometimes some of these challenges are a reflection of their staff, or even bringing on someone new and the errors that happen when that happens. So as you can see, some of our requirements was for them to do 100% file review by their management team, or strengthening their training and their onboarding. And, it's just a constant area of opportunity across the board for property management.
Yeah, I know when these third-party property management contracts come to the commission, in your report, you all cite a number of things related to performance of that contractor. And so I just want to make sure that when a contractor like this one is a party of where we have deficiencies that led to a corrective action plan noted in that review. Okay. I know you're on top of the other thing that is that in our corrective action plan, one course of action is related to training. We're doing. So are we training both the contractor staff as well as our own staff?
No, we are requiring that the contractor has training, and that they're providing that on an ongoing basis. And then we have our own training that's conducted by compliance team, as well as each of the divisions. HRD just hired a new trainer. So we don't necessarily provide training, with the exception of, for example, onboarding into our new Yardi system, working in tandem with the third-party property managers to make sure they understand how to use our system. There's a comprehensive property management guidebook that we've provided to the third-party property managers in regards to our expectations and timing and deliverables. Our finance team provides the third-party property managers with training in regards to how to properly reconcile and when items need to be put in the system. So on that level, yes, but we're expecting, for example, with all of the new changes coming up, although there's been a delay, and you all will get an email here soon. The new date is now January. I think I might have sent that out last week.
You sent it out.
Great. Glad I sent that out. Is now January. We're getting trained up. It's our expectations that our third-party property managers are doing the same. And that's a part of this corrective action plan and our oversight.
Yeah, I asked that question only because a lot of times you see training as being a way to improve performance. And how do you test that? The only way you test it is to see that the same problem that led to the training is still not occurring, right? But you know, I often think that people put that in as a remedy for something, but then don't make sure they follow up. Are people really learning what they're getting trained to do? I mean, the only way you see it is a performance on the other side when you do the evaluation. I understand that. But, you know, I just think that sometimes training is used as a scapegoat for bad behavior or bad practice or bad performance, and it doesn't necessarily correct it.
And Mr. Chairman, I want to thank you for asking the question because I misunderstood. I thought these were files that we were maintaining, but it's the third-party property managers who are not doing their jobs of maintaining these files. And so I thank you for your question for correcting me on that.
Mm-hmm.
And I like the chairman's solution to be part of it, as it is already a condition of our contracts with these vendors, right? That they don't have audit findings in future audits, right?
Yeah.
Good.
And I'll just reiterate some of that. So, you know, Roy asked questions I wanted to ask. So I'm glad to hear that we have increased our oversight of the contractors, because I know we've talked about this in the past. And I guess, you know, on the development companies, I meant to congratulate Tim and the team for all the clean audits. I look forward to when HOC gets its clean audit, and that's when I'll throw the party, Roy.
Very good. Any more questions further about the corrective action plan? If not, I don't think this is a matter that gets referred to the full commission.
No, this is just a report to the committee.
Yeah. So I want to thank you all for that. You know, it's so with that, thank you for your presentation.
Thank you.
Thank you.
You know, it's interesting to me as I sat through as being the chair of this committee, is that those things that come to us as reports and those things that come to us as reports that don't get referred to the full commission. And at some point in time, I want to sit down with you and talk about that, because I just don't sometimes understand why we wouldn't report this to the full commission.
Well, the materials are provided. It's just that it doesn't turn into another item for the full agenda. It's just, you know, the redundancy of it, and the materials are definitely available to everyone.
Yeah. All right. Well, thank you. Thank you very much.
Thank you.
I don't think that there are any other items that's on the agenda for our meeting. So any other questions from any of the commissioners?
Me.
If not, I will declare the meeting of the Budget, Finance, and Audit Committee adjourned as of 12:05 p.m.
Thank you.
Thank you, everybody.
Thank you.